Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
So that's where it basically comes from, what's going on in the spot market, and then I look at my in-the-money value, which again, if we're trading 105, the difference between 105 and my strike price is the intrinsic value. So I get the intrinsic value, which is 5. If the option's trading at 560, the extrinsic value is going to be a total of 60 cents. So 5 plus the extrinsic value of 60 is 560. Using the same methodology, you have the 105 call. It's not worth anything intrinsically. Why? If the U.S. dollar Canadian is trading 105, the right to buy it at 105 is worth nothing really because there's no value, there's no intrinsic value. So it has an at-the-money value of about $2.09. So that option is cheaper than the 100 call, but it's not going to move point for point. It's not going to move at the same fashion, in the same fashion as the 100 call. Now let's look at one other call, the 110 call. So I could buy an out-of-the-money option. Maybe I think that the U.S. dollar against the Canadian is going to move for whatever reason up to 114 or 112. If I buy the 110 call for 55 cents, that's an out-of-the-money premium, and I need the U.S. dollar Canadian to move up to 110.55 before I break even. And I could do similar calculations. If I believe that the commodity market was going to rally and that the Canadian dollar was going to rally, well, I might buy put options on CDD. Because if I'm right and the commodity markets increase, then the U.S. dollar would probably weaken. So some of these puts, whether it's the 110 put, the 105 put, or the 100 put, would gain in value. Now, how much would they gain? Depends on what happens. So if it goes from, like today, Alexander just said that we're trading around 103. If we're trading around 103, I'm just going to round it to make it easy on myself. If we traded at 103, the in-the-money option might be trading at $7.05 or 10 cents. If you only paid $5.30, you'd have a $1.80 profit. However, if it's trading around 103, the 105 might be trading at $2.30, $2.40, whatever. So I paid $1.80, and I'm only up about 60 cents. So, and the out-of-the-money option, you might have been right, but because it didn't move down that quickly, I could actually be losing money on this trade. And if you're having problems on the sound, you can always call the WebEx. Just go to teleconference, and you can get the number there. And William has a question about pips. That's just price interest points in the spot market. But I don't really want to, you don't need to think about pips all that much. You can think about them as cents in the index world, because that's when you're trading these options, it's really like looking at an index. So 104.30, that 0.30 is going to be your cents, if you will, William. So I hope that helps. So moneyness, according to Wikipedia, it's just a measured degree to which the derivative, remember, options are a derivative, it's likely to have a positive monetary value, so in a risk-neutral measure. It can be measured in percentage probability or in standard deviations. What I'm trying to say is, when I went back to those 100, the 105, and 110s, and trying to say, well, how much is the option going to move? How much is the option going to move, theoretically? That's what's called delta. And I'm going to talk more about that on my Greek presentation when I go February 18th, back to basics, FX options Greeks. But essentially, delta means how much, if the underlier changes, how much will my option change? The in-the-money options are going to have the highest deltas, and the out-of-the-money options are going to have the lowest deltas. So that difference between the strike price, so the 100 call, if the index the U.S. dollar against the Canadian, if you will, is trading at whatever, 104, let's make up a number, that delta is going to be pretty high. Why do I say that? Because it's already $4 in the money. In the money options, you're going to have higher deltas. At the money options, you're going to have moderate deltas. And out of the money options, you're going to have low. So I'll just say very, very high deltas. I'll put, let's say, 3 arrows, very high. And if you have no sound or you're using Vista, again, you can call, go to the communicate, and just call in on using your phone. And that's the best thing to do. At the money options, we're going to have, at the money options have moderate deltas. And that's basically, if you're having a problem with sound, again, you can call, and if you're in U.S. or Canada, 866-469-3239 and follow the directions. Thank you, but I can't, Josh, I've answered that question 3 or 4 times. The out-of-the-money options have low deltas. Let me just type it in. So in the money options have the highest deltas. At the money options have moderate deltas, and out of the money options have low deltas. What does it all mean? Remember, at expiration, the difference between your strike price and your asset price is going to create the ultimate value. The options at expiration are either going to be worth the big zero, or they're going to be worth what I call intrinsic. And again, the intrinsic, what's the intrinsic value? Let's see if somebody can do the math. What's the intrinsic value of the 100 call with CDD right now? It's CDD is trading at, where was it trading? 103.43. See if somebody can figure that out. What is the intrinsic value of the 100 call if we're trading at 103.43? We're trading at 103.43. Thank you, Farshad. Thank you. The answer is $3.43. So that's going to move a lot like the spot every day. So if you wanted an option that's going to move a lot like the spot, you could buy one that's in the money. If you wanted to buy one that had a moderate delta, you could buy, let's say, the 103 call. If I wanted to buy one that was more of a leverage prediction, I could buy a 106 or a 107 call. That's the way the options work. How's the cost determined? Well, many factors, but the difference between the strike price and the exchange rate is very, very important. That's how you're going to get paid at expiration. Also, of course, the interest rate differential, which is not very great right now for the U.S. dollar against the Canadian. If you're looking for an interest rate differential, probably the biggest one right now is the Australian against the U.S. Option pricing is based on probabilities. So when I look at, and again, if you come back to the class on the Greeks and options pricing, there's 2 different classes. I'm going to talk about the strike price, the exchange rate, time left, interest rate differential, and volatility. That's what makes up those prices that I use some price as examples, but that's how the market values these options. The interest rate differential is very, very important. And believe it or not, options pricing reflects the assumptions. So if you trade in the spot market every day, there's a debit or a credit to your account based on the interest rate diff. I think this is much more straightforward. It gets priced the first day you trade this option, and that's it. The only time you have to worry about it again is when you close it again. And every day you're going to see the assumptions into the option.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.